Back to the deep dive. Today, we're going to be tackling options trading.
Oh, yeah.
We're going to be really trying to break down all the key concepts and strategies from a really fantastic book, Options Made Easy by Cohen.
Great book.
Yeah, and I know that a lot of our listeners are students, right? So they're coming to this topic maybe for the first time.
Right.
And they really need that extra level of explanation and repetition.
Repetition is key.
Yeah, so we're really going to focus today on making sure that things are super understandable, clear, and engaging.
Absolutely.
And we'll try to even have some fun along the way,
Of course.
right? Make it relatable. So if you're ready to unlock the power of options,
Let's do it.
let's get started.
All right.
Okay, so let's start with the absolute basics, calls and puts.
Right.
These are like the building blocks of options trading.
Yeah, they are the essential components of options trading. Think of options as a right, not an obligation. A call option gives you the right to buy an asset. Usually we're talking about stocks at a fixed price,
Okay,
which is known as the strike price,
got it.
before a certain date.
Okay,
And that's the expiration date.
so it's kind of like having a special ticket
Uh-huh.
that lets me buy, I don't know, limited edition pair of sneakers or something
Right.
at a set price.
Exactly.
Even if like everybody else is going crazy and trying to pay way more.
You got it. Yeah, that's a great analogy.
Okay, awesome.
Now, a put option is the reverse of that.
Okay,
So it gives you the right to sell an asset at a predetermined price before that expiration date.
okay. So if I think the price of something's going to go up,
Yeah.
I buy a call. If I think it's going to go down,
Buy a put.
if I put.
You got it.
Okay.
Now, there's one little detail we need to throw in there, which is American style versus European style options.
Oh, okay. What are we talking about? Finance or breakfast menus here?
It does sound a bit like that, right? Haha. But the difference is actually pretty simple.
Okay.
With American style options, you can exercise your right to buy or sell anytime before the expiration date,
Okay.
whereas European style options only let you do it on the expiration date itself.
So American, I have a little more flexibility.
Exactly. More flexible.
Okay, that makes sense. But these options, they have a price tag, right?
They do.
What are the things that kind of make their value go up or down?
So there are a number of factors. Let's start with the price of the underlying asset.
Okay,
So that's the stock itself.
got it.
Then you've got the strike price,
Uh-huh.
which is the price that you've locked in for buying or selling. And then the time until expiration also matters.
Okay.
The further out the expiration date,
Yeah.
the more time the price has to move in your favor.
Right.
And that adds value to the option.
So more time equals more possibilities.
Precisely. But perhaps the most crucial of all these factors is volatility.
Okay.
Now, volatility is a measure of how much the asset's price is swinging up and down. Think about a roller coaster.
Okay.
The wilder the ride, the higher the volatility.
Okay, so the more unpredictable it is, the more the option's worth.
Generally, yes, because a volatile stock has a much greater potential for large price swings,
Right.
which could end up working to your advantage.
Gotcha. Now, you mentioned something earlier called intrinsic value and time value.
Right.
How do those kind of play into all of this?
Good question. Intrinsic value is the profit you would make if you exercised your option right now.
Okay.
So, for example, if you have a call option to buy a stock at, let's say, $50 and it's currently trading at $60,
Uh-huh.
your intrinsic value is $10, the difference between the two prices.
Because I could buy it for 50 and immediately sell it for 60.
Exactly.
Okay.
Now, time value is the additional value that's baked into the options price because of the potential for the stock price to move even further in your favor before the expiration date.
So it's kind of like how a concert ticket gets more expensive the closer it gets to the show?
Perfect analogy.
Right.
Because there's still that chance that the price could go up even more. And remember, that volatility we talked about plays a big role in time value.
Okay.
The higher the potential for those price swings, the higher the time value.
So if I have a volatile stock with a long time until expiration,
Yeah,
that's probably going to have a higher time value.
you got it. Now, let's talk about another critical aspect of options trading, risk.
Right, because everybody wants to make money,
Uh-huh.
but nobody wants to lose it.
Exactly. So understanding risk profiles is essential. When you buy a call option, the most you can lose is what you paid for it, which is called the premium.
So the price of my sneaker ticket, in my analogy.
Yes. But your potential profit is unlimited because the stock price could theoretically go up forever.
Right, in theory.
Buying a put option works very similarly, limited risk, but potential for profit if the stock price drops significantly.
Okay, but what about selling options? That sounds a little riskier.
It can be. Selling a call option means that you're obligated to sell the stock at the strike price if the buyer exercises their right.
Okay.
And in this case, your potential loss is theoretically unlimited because, again, there's no limit to how high a stock price can go.
Yikes. Okay. So selling a put option,
Yeah.
that means I have to buy it, right?
That obligates you to buy the stock at the strike price
Okay.
if the buyer exercises their right.
Got it.
Your maximum risk there is capped because the stock price can't go below zero, but it can still be a significant loss.
Okay, so buying options, limited risk, selling them,
Yeah,
a little more of a gamble.
that's a good way to put it.
Okay, so we've got the basics of calls and puts. We understand how those are priced. But where does all this trading actually take place?
Right.
How do we jump into the marketplace?
That's where we start to get into the mechanics of the market. Things like option quotes, margin requirements, and all the different types of trade orders you can place.
All right, let's dive into that. All right, so we've laid the groundwork. We know about calls and puts and how their prices fluctuate. But let's get to the exciting part. How do we actually start trading these things? Where does it all happen?
Think of it like an online option, but instead of bidding on that vintage record player, you're bidding on options contracts.
Okay, so buyers and sellers all in one place.
Precisely. They come together, try to agree on prices, and most of this is happening electronically these days.
Makes sense. So I need to get myself onto one of these platforms.
Exactly. You'll need to open an account with what's called a brokerage platform, one that specifically offers options trading.
Got it. So I've signed up, got my platform, feeling good, ready to make my first trade. What happens next? How do I even understand the prices they're showing me? And what is all this talk I hear about margin requirements?
Okay, so option prices are typically quoted in terms of what's called a premium.
Premium, okay?
And it's per share. For example, let's say you see a call option with a premium of, let's say, $2.50. That means you'll pay $2.50 per share for the right to buy 100 shares of that underlying stock.
Hold on. 100 shares. So I'm not just buying one option. I'm buying like a bulk package of them.
That's right. Option contracts represent 100 shares of that underlying stock. So in your example, you'd actually be paying $250 for that call option contract.
Ah, okay. So it's $2.50 times the 100 shares.
Exactly.
Okay. So even if that premium per share seems small, the total can get pretty big.
Yeah, it can add up quickly. And that brings us nicely to the topic of margin requirements.
Okay.
Now, when you sell options, you're essentially taking on a lot of potential risk. Remember, we talked about naked call selling earlier, unlimited risk.
Yeah, not a fan.
Right, so to cover that potential risk, your broker is going to require you to have a certain amount of cash or securities set aside in your account.
So it's kind of like a safety net for them.
Exactly. It's called margin. Margin helps ensure the stability of the market.
Okay, I get it. So it protects both the buyer and the seller, right?
Absolutely. Now, here's a bit of a twist, though. You can't buy options on margin.
Wait, what? Why not? I can use margin for stocks. What's the difference?
It all comes down to leverage.
Okay.
You see, buying options already gives you quite a bit of leverage.
Okay.
Even a small change in the stock price can lead to a much bigger change in the option's value. So if you were allowed to buy options on margin, it'd be like amplifying that leverage to a dangerous degree.
Ah, okay. Too much leverage. Things can spiral out of control quickly.
Exactly. It's like playing with dynamite. So speaking of managing risk, let's talk about the different types of orders that you can place, those instructions you give to your broker about how you want to buy or sell.
Yeah, okay. So what are my options there?
Well, you have your basic order, which is called a market order.
Okay.
And that's basically just saying, hey, buy or sell at the best available price right now.
Okay, so that's the fastest way to get things done.
Exactly. But the trade-off is you have less control over the exact price.
So it's feed versus control. Gotcha. What else is there?
Then you have what are called limit orders.
Okay.
With limit orders, you set a specific price.
Okay.
So you're basically saying, hey, I'm only willing to buy at this price or lower, or I'm only willing to sell at this price or higher.
So it's like setting boundaries so you don't overpay.
Exactly. Limit orders give you more control, but they don't guarantee the order will go through.
Right, because the market might not ever hit that price is set.
Right. Then you have what are called stop-loss orders, and these are really, really important for managing risk. This is where you set a specific price at which you want to automatically sell your stock or your option to limit any potential losses.
Ah, okay, so it's kind of like an emergency brake on a runaway train.
Perfect analogy, and it helps take the emotion out of those tough decisions.
I like that. Anything else I should know about in terms of order types?
Yeah. You can also set time limits for your order, such as good till canceled or fill or kill.
Okay. So good till cancel is pretty self-explanatory. It'll just keep trying till it gets filled or I cancel it.
That's right. And fill or kill means either execute the order immediately at this price or just cancel the whole thing.
Ah, okay. So there are a lot of options within options, pun intended.
There are. Haha. It's important to learn about these mechanics, understand how the marketplace operates. But it's not just about buying and selling. It's about understanding the assets you're actually trading. That's where fundamental and technical analysis come into play.
All right, let's shift gears a bit and talk about those analyses. They sound a little intimidating, though.
Don't worry, we'll break them down and make them super easy to understand. Think of fundamental analysis like taking a peek under the hood of a car. You want to see how well the engine's running, right?
Okay, so fundamental analysis is looking at the nuts and bolts of the company.
Exactly. You're examining its financial health and performance, making sure it's a solid investment.
So like a doctor checking a patient's vital signs.
That's a great analogy. You're looking at revenues, profits, assets, debt, the whole picture to figure out if this company's actually doing well and whether its stock is likely to increase or decrease in value over the long term.
Right, because if I'm going to bet on the company, I want to make sure they're in good shape.
Exactly. And remember, stock prices are often driven by expectations, what people think is going to happen with the company. So if you understand the fundamentals, you get a better idea of where that stock price might be headed.
Okay, so where do we even begin with this fundamental analysis? What should I be looking at?
One of the most helpful tools are financial ratios.
Okay.
These are quick calculations that tell you a lot about a company's financial health. A really common one is the price-to-earnings ratio. You might have heard of it, the PE ratio.
I've heard of it, but I'll admit I don't really know what it means.
Well, it's basically the stock's price divided by the company's earnings per share.
Okay.
And it essentially tells you how much investors are willing to pay for each dollar of earnings.
Got it.
So a high PE ratio could mean that investors are feeling optimistic about the company's future growth.
So a high PE ratio is a good thing.
Well, not always. It could also mean that the stock is actually overvalued.
Okay.
You have to take it in context. What's considered normal varies between different types of companies.
Right, so a high PE ratio for a tech startup is a lot different than for a, more established company.
Exactly. Another important ratio is the debt-to-equity ratio.
Okay.
And this compares a company's total debt to its shareholder equity. And a high debt-to-equity ratio usually means there's a greater financial risk.
So a company with a ton of debt might be more vulnerable when the economy takes a downturn.
Exactly. Think of it like comparing someone with a massive mortgage versus someone who owns their home outright. The person with less debt is generally in a better position, less vulnerable to outside forces.
That makes sense. Are there any other sort of red flags I should watch out for when I'm doing this fundamental analysis?
Definitely pay close attention to trends, especially in the company's revenues and profits. Are they going up? Are they shrinking? Are they just staying the same? Consistent declines in these areas can be a sign that something's not quite right. And don't forget about the management team.
Okay.
Do they have experience? Have they made good decisions in the past?
So it's not just about the numbers, it's also about who's running the show.
Exactly. And remember, the big wide world of the economy also plays a role. Things like GDP growth, inflation, interest rates, those can all impact a company's performance and, by extension, their stock price.
Wow, so it's like this big interconnected puzzle. All right, so we've got fundamental analysis focusing on the company itself. What about this technical analysis I keep hearing about? That sounds a little more mysterious.
Think of technical analysis as the art of chart reading and pattern spotting. You're analyzing a stock's price history and trading volume to find those trends and try to predict what's going to happen in the future.
So instead of looking at the company's books, we're looking at how its stock has actually been performing.
Exactly. Technical analysts believe that those past movements, those patterns, often repeat themselves, and those repetitions can give us clues about what might happen next.
Interesting. So it's like looking for patterns in code to try and predict what's going to happen next in a video game.
That's a great analogy. One of the most basic things to understand with technical analysis is the concept of support and resistance.
I've heard those terms thrown around, but never fully understood what they meant.
Well, think of support as that price level where a stock tends to stop falling and start bouncing back up.
Okay.
It's like a floor that's propping up the price.
So then resistance would be the opposite, like a ceiling that's stopping it from going up any higher.
You got it. And when a stock breaks through those support or resistance levels, that can signal that something's changing and a big move could be coming.
Like the stock's breaking free from its constraints. All right. So what else are these technical analysts looking for?
They also look for patterns in the charts, things like double tops and double bottoms.
Okay, those sound familiar. They're the ones that kind of look like an M or a W, right?
Exactly. A double top can sometimes mean an upward trend is about to reverse, while a double bottom suggests a potential upward reversal.
Interesting. So these patterns can help us get a sense of where things might be going. But is it foolproof?
Unfortunately not. It's all about probabilities. You're making educated guesses, but there are no guarantees in the market.
That's for sure. So what other tools are in this technical analysis toolkit?
They also use things called technical indicators. These are mathematical calculations based on the price and volume data. Moving averages and the RSI are a couple of examples.
Okay.
And these can be super helpful. They can help you see if a stock is overbought or oversold, and that can hint at a possible turning point in the price.
Sounds like there's a lot to learn in the world of technical indicators. So much to keep track of.
There is. But just start with the basics. Don't get overwhelmed. As you get more experience, you can always add to your knowledge.
That's good advice for almost anything, really. Start with the fundamentals. So we have fundamental analysis, all about the company itself, and technical analysis, looking at the patterns and indicators. Traders usually pick one or the other, or do they use both?
The best approach is actually to use a blend of both.
Okay.
Fundamental analysis can help you find those strong companies, the ones with real potential for growth, and technical analysis can help you figure out the best time to buy or sell.
Ah, okay. So it's like having two different lenses to view the market, and using both gives me a much clearer picture.
Exactly. That's a good way to think about it. A balanced approach is really key to making those smart trading decisions. And remember, we're here to help you understand all of this and feel good about using it. We've covered a lot of ground here, so please rewind, revisit any sections as many times as you need.
Yeah, this is a lot of info. Repetition really is key.
It is, and don't be afraid to ask questions. The more you ask, the better you'll understand.
Okay, so we've done the basics of options, learned about the marketplace, and even explored fundamental and technical analysis. Now I'm ready for the main event. Tell me about actual trading strategies. How do we put all this knowledge into action?
This is where things get really exciting. There are a ton of different option strategies out there, each one designed for certain market conditions and levels of risk tolerance.
All right, bring on those strategies. I want to know how to use options to make some money and, of course, manage my risk wisely.
Sounds good. Let's start with a couple of basic strategies that are used by just about everyone, from newbies to seasoned pros. Covered calls and protective puts.
Covered calls and protective puts, those sound interesting. Break it down for me.
Okay, so a covered call is a strategy where you own the stock already,
Okay.
and then you simultaneously sell a call option on that stock.
So I'm selling someone else the right to buy my stock. Why would I want to do that?
Great question. The main reason is to make some extra cash. You get this premium for selling that call option. It's like you're renting out your stock for a fee.
Okay, and then they could potentially buy it later on.
Right, if the price goes up.
Okay, I see the logic here. So I can profit from a stock I already have, even if the price doesn't move that much.
Exactly. Now, a protective put is kind of like the flip side. You're buying a put option on a stock you own to protect yourself against a potential price drop.
Ah, so it's like buying insurance for my stock, just in case things go south.
Another perfect analogy. So if that stock price falls, that put option you bought gives you the right to sell those shares at a certain price, and that limits your losses.
Okay, so both strategies use the stock I already own, but they have very different goals.
Right. Covered call is mainly for generating income.
Okay,
Protective put is for mitigating risk.
got it. Let's look at an example for each. I'm a big example person.
All right, good. Say you have 100 shares of a company called, let's say, Teco,
Okay,
and it's currently trading at $50 per share. You're feeling good about Teco long term, but you wouldn't mind making some extra cash from those shares you have.
yeah, passive income's always nice.
It is. You could sell a covered call option with the strike price, let's say, $55, expiring in 1 month.
Okay,
And let's say the premium for that call option is $2 per share. So remember, each contract represents 100 shares. You'd receive $200 in premium for selling that one call contract.
so I'm basically getting $200 up front for letting someone potentially buy my shares at $55.
Exactly. Now let's walk through the different possibilities here.
Okay,
If the price of Teco stays below $55, that call option expires worthless.
okay.
You get to keep that entire $200 premium, plus you still own your 100 shares.
Sounds like a win-win.
It is, but what happens if the price goes above $55?
Well, that's where things get a little trickier, right?
It could. If the price goes above $55, that buyer might exercise their right to buy those shares from you.
Right.
So then you would be obligated to sell them, even if the price is higher than that.
So I could miss out on even bigger profits if the stock really takes off.
That's the risk. But remember, you're still making a profit. You bought those shares at $50, sold them at $55, and got an extra $2 per share in premium. Not bad.
Right. Okay. So I'm trading potential profit for some guaranteed income. What if the price actually drops?
Well, that's the other risk with a covered call. You're still exposed to losses if the price tanks. But at least the premium helps cushion the blow.
Okay, so I'm only using this when I'm feeling good about the stock and okay with giving up some potential gains for that extra income.
Exactly. All right, let's look at protective puts. Remember, you've got those 100 shares of TikTok.
Uh-huh.
But now let's say you're a little nervous about the market. You think there might be a correction coming. You're still bullish long-term on Teco, but you want to protect yourself in the short term.
Yeah, a little insurance never hurts.
Right. So in this case, you would buy a protective put option. Strike price, let's say $45, expires in 1 month, and let's say the premium on this is $1 per share. So you're paying $100 for that contract.
So I'm paying $100 to protect my $5,000 worth of stock.
Exactly. If the price stays above $45, that put option expires, and you're out that $100?
Like paying for insurance I never used.
Exactly. But now, if the price dips below $45, you can exercise your right to sell at that price and avoid bigger losses.
Okay, so like a safety net that kicks in if things get really bad.
Exactly. So protective puts, really helpful for managing risk, especially in uncertain markets.
Okay, I'm seeing how powerful even these basic strategies can be.
They're like tools in a toolkit. Covered calls when you're feeling bullish, want that income. Protective puts for when you're feeling a little more cautious.
I like that. Okay, this is already super helpful. I feel like I'm really getting a grasp on how options work and how to manage risk and make some money. But I know there's still so much more out there to learn. What haven't we covered yet?
One more important piece we need to talk about, the Greeks. These are measures of risk.
The Greeks, like ancient Greece. Are we going to have a history lesson now?
Not quite. Haha. It's just a name. These are essential tools for making those informed trading decisions. Don't worry, we'll keep it simple. We'll break down what each one represents, why they matter.
All right, I'm ready to decode these mysterious Greeks. Let's do it. All right, so the Greeks, lay it on me.
Okay, so the Greeks, these are basically just ways to measure how sensitive an option's price is to different factors.
Okay,
They're called Greeks because, well,
because they're represented by Greek letters.
exactly, you got it. Haha.
Okay.
Don't worry, you don't have to be a math genius or anything. We'll stick to the important ones for beginners.
All right, sounds good. So which one should we start with?
Let's start with delta. That's one of the most important ones.
Delta, okay.
Delta basically measures how much an option's price is going to change for every dollar that the underlying asset's price moves.
Okay.
It's basically a measure of responsiveness.
Okay, so if the stock goes up by $1 and my option has a delta of, let's say, 0.5, the option price goes up by 50 cents.
You got it. Now, delta values for call options, those range from 0 to 1.
Okay.
For put options, they range from -1 to 0.
Okay, so the higher the delta, the bigger the price swing in my option.
Correct. The more sensitive it is to changes in that stock price.
Got it, okay. What about theta?
All right, theta. Theta measures something called time decay. Remember we talked about that earlier, how the value erodes as it gets closer to the expiration date.
Right, that concert ticket analogy.
Exactly. So theta puts a number to that erosion.
Okay, so a high theta means it's losing value quickly. That's bad, right?
Well, it's not necessarily good or bad. It's just information you need. Theta is always negative because options, by nature, are always losing value over time.
Okay,
But the rate of that decay can vary depending on things like the time left until expiration, volatility.
so if I'm buying an option, I probably want a lower theta.
Right, you don't want that value to disappear too fast.
But if I'm selling, maybe a higher theta is better.
Exactly, because then you want that op-up to expire worthless.
Okay, makes sense.
Now, there's also gamma.
Gamma, okay.
Gamma is a little tricky. It measures how much the delta is expected to change.
The delta sensitivity. Okay, this is getting complicated now.
Yeah, it can be a bit hard to grasp, but think of it this way. Gamma tells you how much an option's price accelerations is going to change as the underlying asset's price moves. So a high gamma means the option's delta is going to change a lot, making the price swings even more dramatic.
Okay, I think I'm getting it. So we've got delta tells us the magnitude of the price change, theta's about that time decay, and gamma is all about how sensitive the delta is.
You got it. Exactly. We'll skip over vega and rho for now. Those are a bit more advanced. Vega has to do with volatility changes, and rho measures the sensitivity to interest rates.
Okay, I'll take your word for it. So even though these Greeks seem complicated, they're really just tools, right, to help us make better trading decisions.
Absolutely. Now that we've got a handle on the basics, let's talk about some more advanced options strategies. Remember those bull spreads?
Oh yeah, for when we're feeling optimistic.
Right. So bull spreads are a way to leverage that optimism, but in a more measured way. Manage your risk. There are two main types, bull call spreads and bull put spreads.
Okay, and how do those work again? Refresh my memory.
Okay, a bull call spread. You buy a call option with a lower strike price, and then at the same time, you sell a call option with a higher strike price.
Okay.
Both with the same expiration date.
Okay, so I'm buying one, selling the other. What's the point of that?
It's about creating a range where you think the stock is going to move. You collect that premium by selling that second call, and that helps lower your overall costs and limits your risk.
Okay, so my potential profit's capped because I'm selling that second call.
Correct. The maximum profit is the difference between those strike prices minus the premiums that you paid.
Okay, that makes sense. What about a bull put spread?
A bull put spread, you buy a put option with a lower strike price and sell a put option with a higher strike price. Again, same expiration date.
Okay, so it's like a mirror image of a bull call spread.
Exactly. But with a bull put spread, you're actually betting that the price is either going to stay above that higher strike price or maybe even increase a little.
So even though I'm using puts, it's still a bullish strategy?
It is. Your maximum profit is that net premium you get, and the risk is limited to the difference between the strike prices minus that premium you received.
All right, I think I'm starting to get these spreads. These seem like a good way to kind of control things a bit more.
Yeah, they're a bit more conservative.
But what about when things are really volatile?
Uh-huh.
Like, I don't know which direction the price is going to go, but I think it's going to go somewhere big. What do I do then?
You're talking about volatility plays.
Okay.
So for that, we've got strategies like straddles and strangles.
Straddles, strangles. Okay, that sounds interesting.
They are. A straddle involves buying both a call option and a put option with the same strike price and the same expiration date.
So it's like I'm saying, I don't care which way it goes as long as it makes a big move.
Exactly. You're just betting on a large price swing one way or another.
Okay, so unlimited profit potential.
Unlimited because the stock price could, in theory, keep going up or down forever.
Sign me up. But what about the risk?
The risk is also pretty significant, but it is capped at the total premium that you paid for those options.
Okay, so my potential loss is limited to how much I paid up front.
Exactly.
All right, I can live with that. What if I want to kind of spread those strike prices out a bit? Is that a thing?
That's called a strangle.
Strangle, okay.
Similar to a straddle, but instead of buying both those options at the same strike price, you buy a call option with a strike price above the current stock price and a put option with a strike price below the current stock price.
So I'm basically casting a wider net.
Exactly. You're looking for a bigger move. Now, a strangle is usually a bit cheaper because the options are further out of the money, but that also means the stock has to move a lot more for you to really profit.
Okay, well, I see. Higher risk, higher reward with a straddle, but lower cost with a strangle. This is all a lot to think about. You know, it just occurs to me, no matter how much I learn about options, all these strategies and the Greeks and all that, my own emotions could really mess things up.
Absolutely. That's why trading psychology is so important. It's often the overlooked piece, but it can make all the difference.
I know. I've definitely made some rash decisions in the past because of fear or greed, and I've regretted them later. So how do we keep our emotions in check?
The most important thing is to have a plan. Before you make any trades, decide on your entry and exit points. Figure out how much risk you're comfortable with, what kind of profit you're aiming for, write it all down, and stick to it.
So it's like having a roadmap. So when things get crazy, I don't panic and make a bad decision.
Exactly. A plan keeps you disciplined.
Makes sense. But how do you deal with those emotions like fear and greed?
One thing that can help is to visualize. Think through different scenarios, good and bad. Imagine what you'll do if the trade goes your way, and what you'll do if it doesn't. Being prepared can help you stay calm.
So like mentally rehearse so I don't get caught off guard.
Exactly. Mindfulness is important too. Really pay attention to how you're feeling.
Okay.
Notice when you start getting anxious or greedy. Take a step back, take a breath, and really reassess the situation.
It's all about being aware of myself and staying in control.
Exactly. And remember, this is a journey. You're always learning and growing as a trader.
This has been an incredible deep dive. I feel like I have a much better understanding of options now. We covered so much ground, from the basics all the way to advanced strategies and the mental game. Thank you so much.
You're very welcome. It was my pleasure. And to all our listeners out there, remember, this is just the beginning. Keep learning, keep exploring, and never stop asking questions.
That's great advice. And that is a wrap for today's episode of The Deep Dive. Thanks for joining us. 1875 Seasons.